Okay, so let's be real. Just leaving your savings to sit in a regular account. Well, we're going to explore some popular choices. High-yield savings accounts, CDs, those certificates of deposit, and money market mutual funds. And by the end, you'll know which one could be your financial superhero. So first up, let's talk about high-yield savings accounts. These are like the upgraded version of your regular savings account. They offer a much better interest rate, like way better, sometimes even 2 to 5 times higher. And why is that? Well, it's because they're usually offered by these online banks. And because these online banks don't have all the costs of running those physical branches, they can pass those savings on to you, in the form of higher interest payments. Pretty neat, right? Plus, you get easy access to your cash whenever you need it. No jumping through hoops or anything. And just like those traditional savings accounts, high-yield savings are generally FDIC-insured, meaning your money is protected up to $250,000, even if the bank, well, goes belly up. But here's the catch. Interest rates, they can fluctuate. It's just the way it goes. And, if you're someone who really likes going into a physical bank branch, you'll have to get used to doing everything online with a high-yield savings account. Now, let's switch gears and talk about CDs, those certificates of deposit. Think of a CD as a time machine for your money. You lock in a fixed interest rate for a specific period of time, kind of like setting the controls on that time machine. And you can't really mess with it once it's set. Now, these terms can range from a few months to several years. And here's the exciting part. The longer you commit your money, the higher that potential interest rate goes. So with a CD, you know exactly what you're getting. It's predictable, stable growth, and it's also FDIC insured. Sounds good, huh? But there are a couple of things to consider. The biggest one is that if you need to withdraw your money before the CD term is up, you're probably going to get hit with an early withdrawal penalty. Ouch, right? And another thing, what if market interest rates go way up while your money is locked in that CD? You might miss out on those higher returns. But don't worry. There's a pretty clever way to maximize your returns. And keep some flexibility too. It's called building a CD ladder. This is where you split your money and invest in multiple CDs with different maturity dates, creating a kind of staircase of CDs. And as each CD matures, you can either reinvest at the current rate or access your funds without that penalty. Pretty neat, huh? All right, let's move on to money market mutual funds. Now, these are like investment pools where your money is combined with other investors' money. And the fund manager then invests that big pool of money in super safe short-term jets, like treasury bills. And, you guessed it, certificates of deposit. You can usually find and manage these funds right in your brokerage account, so they're pretty easy to access, historically. Money market mutual funds tend to follow the interest rates set by the Federal Reserve, which means they often offer a slightly higher yield than traditional savings accounts. You could usually redeem your shares pretty quickly, and they're generally considered low-risk investments. But unlike our high-yield savings accounts and CDs, money market mutual funds are not FDIC insured. Now, don't panic. Many of these funds are very conservative with their investments. But it's still something to keep in mind. Also, remember that money market mutual funds do have management fees. Not uncommon. While it's not common, share prices can fluctuate. In some extreme market conditions, those share prices could even drop below $1 per share. Again, it's not common, but it's something to be aware of. So, you might be thinking, okay, but how do I choose the right option for me? Well, it all depends on your own financial situation and goals. So let's break it down, okay? First things first. You got to think about how quickly you might need to access your money. We call this liquidity, right? So like if you're building an emergency fund, you'd need that cash available right away, just in case something unexpected happens. In that case, a high-yield savings account is probably your best bet. You earn a decent return, and you have that peace of mind knowing you can grab your money anytime. You're thinking long-term, like saving for a down payment on a house, maybe a few years down the road. Well, a CD might be a good option for you then. You lock in a solid interest rate for that whole CD term, and just watch your money grow. Just make sure you choose a term that fits your timeline, so you're not stuck needing that money before the CD matures. Now, here's another scenario. Imagine you're an investor, right? You've already maxed out those contributions to your retirement accounts, like your 401k or IRA, and you have a little extra cash you want to invest. But maybe you're not ready to jump into the stock market just yet. Well, a money market mutual fund. That could be a good middle ground. You could potentially earn a slightly higher return than a traditional savings account without taking on all the risk that comes with stocks. But remember, everyone's financial goals are different. What works for one person might not be the best for you. So really think about what's important to you. Do you want to maximize your returns? Or is minimizing risk your top priority? Once you've got a clear picture of your needs and goals, then you can confidently navigate all these different options. You know, high-yield savings accounts, CDs, money market mutual funds. Before we move on, let me just give you a few quick tips. First, don't put all your eggs in one basket. Okay, diversifying your savings and investments. That's super important for building a solid financial foundation. So maybe stash some cash in a high-yield savings account for easy access. Lock in some money in a CD for that steady growth. And maybe try dipping your toes into a money market mutual fund for an extra boost. Second tip, keep your eyes peeled for those promotional rates and bonuses. Banks and financial institutions are always offering deals to attract new customers. Take advantage of these to really boost your returns. And finally, don't be afraid to make changes as your financial goals change and as the market changes. It's important to review your savings and investment strategy every now and then. Make adjustments as you need to make sure your money is always working as hard as you are. So there you have it. High-yield savings accounts, CDs, money market mutual funds. They each have their own advantages and things to think about. The key is to choose the options that best fit your own financial journey. Do your research, compare rates and fees, and don't be afraid to ask questions. Your financial future, it's worth it. Okay, so remember that CD ladder strategy we talked about earlier. Let's dig into that a little bit more. It's a pretty smart way to get the best of both worlds, You get the potential for those higher CD returns, but you still have some flexibility if you need it. So picture this. You have, let's say, $10,000 that you're ready to invest in CDs. Now, instead of putting all of that into one 5-year CD, you can split it up, right? Like into 5 separate CDs of $2,000 each with a different maturity date. Maybe 1 year, 2 years, 3 years, 4 years, and 5 years. That way, as each CD matures, you've got a choice to make. You can either withdraw that money without any penalty if you need it, or if interest rates have gone up in the meantime, you can reinvest that matured amount into a new CD at that higher rate. So you're always getting the best possible return. And you still have access to some of your funds each year. It's a win-win, right? But of course, no single strategy is perfect for absolutely everyone. It's all about finding what works best for you, for your own situation and goals. And that brings us to the most important point. Knowledge is power. The more you know about all these different options, the better decisions you can make about your money, right? So keep learning. Keep asking questions. Keep exploring this whole world of personal finance. It's a journey for sure, but it can be a pretty rewarding one too.